Hey everyone, it's your investing coach Wahidah here. Welcome back to my channel. This is where you can learn how to invest and build wealth, even if you are the first person in your family to do so. Okay, let's jump in. Today we're going to be talking about how you should be investing even if you have debt. And you may think that you should only start investing once you are debt free. And there is advice like this out there. I'm thinking about the Dave Ramseys of the world. But if you wait until you're debt free to invest, you could be losing out on years of wealth building. So it may make sense in certain scenarios where you should pay off your debt first before you start investing the money. But then there are other scenarios where it makes sense to kind of do both in tandem with each other, paying your debt and then also investing the extra you may have. Okay, how is this that we can pay debt and invest at the same time and have it make sense? Well, let's look at the numbers. Really what we're looking at is the interest rates of your debt. We want to look at how much your debt is costing you versus the average returns of the stock market. So we want to look at how much is your debt costing you versus how much money can we be making off of the market if we invested it. So we're comparing the difference. So what's the average return we can expect from the market? Well, let's take a look at the S&P 500, the S&P 500. So the S&P 500 is often used as a benchmark on what we can expect to make if we invested in the stock market. This S&P 500 index is essentially a tracker that tracks the largest 500 companies in the US at any given time. So we're looking at companies like Amazon, Google, Apple, Facebook. These are like major players. So over the last 30 years in the S&P 500, it has returned on average about 10%, roughly 9.88%. So in this graph, you can see that the S&P 500 over the last 90 years isn't a straight line. Like it goes up some years, it goes down some years. But overall, when we look at the big picture, it's going up. And with this data, we can trust that the stock market will essentially go up over the long term. So just for fun, let's take a look at if we invested $500 every month into the S&P 500 over the next 30 years, estimating a 10% return, we would have roughly $980,000 in our account in 30 years. That's a lot of money. That is a lot of money. So that's why we don't want to be missing out on wealth building opportunities. Okay, now you may ask, well, Wahidah, how do I know if I have debt, if I should be also investing? And again, we're looking at the difference between the interest rates and the average returns on the stock market. So we all know debt costs money. So when you have debt, you want to focus on your interest rate. You want to know how much is your debt costing you versus how much can we make off the stock market. And I'm not saying to not pay off your debt, right? Like we still got to do that. We legally signed into a contract saying that we would pay off our debt. But what we want to look at is after you pay your minimum payment on your debt, if you have extra money at the end of the month, where should that extra money go? So if you do have extra money at the end of the month after you pay your bills, first off, congratulations, like go you. This is a huge accomplishment. But now let's take a look at where we can put this money. Let's look at an example. Let's say you have, just to make things easy, you had a $100,000 mortgage at 5% interest per year. And now at the end of every year, you have roughly $1,000 extra to put towards your mortgage or investment or kind of wherever, right? We've got just an extra $1,000. What can we do with this? Now, without needing to complicate the math, we really just want to, again, look at the interest rate and the average returns on the stock market. So if we have an extra $1,000 at the end of the year and we want to do something with it, if we were to put that extra $1,000 into our mortgage, we would be saving 5% essentially off of the mortgage, essentially off that $1,000. So now, if we were to take that same $1,000 and invest it into the stock market, you can expect a 7 to 10% return over the long term. Just to break it down again, so if we put $1,000 into an extra $1,000 into our mortgage, you'd save that 5% interest rate. So essentially means you would save $50. If you invested the $1,000 into the stock market and you got 8% annual return on it, you would now have a gain of $80. So beginning of the year, you put $1,000, and if we had an 8% annual return, at the end of the year, that account would have $1,080. So it would be a gain of $80. So you can see from this scenario that if we were to invest that $1,000, we would be, even if we had to pay the extra 5%, right, off the mortgage, we would still be $30 up, right? Because we're taking the $80 that we would have gained from the stock market, and we're going to subtract the payment that we have to pay, right? Like if we're investing the money, now we have to make this interest rate payment off the mortgage, and that's $50 extra because we didn't pay $1,000 extra to the mortgage. So now we're taking $80 minus 50, and which means we would have an extra $30 at the end of the year. So you're still up, even if we're going to pay an interest rate on our debt. Okay, now there are situations where we're just gonna have to pay our debts first, and you want to prioritize your debts. And this is if you have high interest debt. So think credit card debt, think personal loans, anything really over like 11% interest rate. That's when we're wanting to prioritize paying that debt off first. And that's because that debt is costing you more compared to if you were to invest the difference. And especially if you have that credit card debt or personal loan, because those can go upwards of 20%, if not more. And I don't think they should be a thing, but they are. So if you have those high interest debts, please take care of those first before you think about investing the difference. Okay, and that is it for me today. Come back every Monday for new videos. Again, this information that we are talking about today, none of this is advice. It's all educational for you to be able to make educated decisions down the road. All right, well, thanks so much. See you guys later. Bye.